Good afternoon, ladies and gentlemen. I'm Rajesh Merchandani. I'm the Vice President for Communication and Policy Outreach here at the Centre, and I'm delighted to welcome so many of you here for the launch of today's report, Financial Regulations for Improving Financial Inclusion, and the discussion of the report and the issues that it raises. Now, this is a big year for CGD. It's our 15th anniversary, as our clever logo points out. And this year we're thinking about big themes. Earlier in the year, we had the former USAID Administrator Raj Shah here to talk about the future of aid. What could be a bigger theme than that? We also welcomed the Pulitzer Prize-winning New York Times columnist Nick Kristof to talk about gender equality and the private sector. There are more big events on the way on transparency, on the future of multilateral development banking, on energy access, and their major policy speeches from key players as part of our 15th anniversary Development Leaders series. Today, we're talking about another big theme, another way to alleviate poverty in aid development, and that is financial inclusion. Simply put, if more people can make payments digitally as well, through systems like M-Pesa, or even using digital wallets or online accounts, that means they can plan their finances better. They can even save, they're more secure, they can grow their assets, and that's good for development. Don't forget also, we have the landscape of the Sustainable Development Goals that are setting the agenda for development for the next 15 years. Financial inclusion is part of that agenda, and financial inclusion is also something that can help us make progress towards many other SDGs. World leaders have bought into the idea of financial inclusion, including the US, and we'll hear from the US Treasury very shortly. Financial inclusion, as we know, is a buzz phrase. It'll be on the lips and on the minds of G20 leaders later this year. But how does financial inclusion work? What does it actually need? Often we hear about great new technologies or schemes that enable money transfer, and sometimes we hear about the problems of money transfer. And in fact, CGD's report last year on the unintended consequences of anti-terror legislation and on de-risking looked at that. And I know the US Treasury has been thinking a lot about that as well. Today, we're looking at one aspect of financial inclusion that doesn't get much attention, and that's regulation. Why is that? Because financial inclusion to end poverty has not really been the traditional priority of financial regulators. They have three traditional mandates. Safeguarding the stability of the financial system, that means no banking crises, things like that. Safeguarding the financial system's integrity, and that means things like clamping down on money laundering, and protecting consumers from fraud. But what this report does is that it says to regulators, you know those three traditional mandates? Well, they can be compatible with the goal of financial inclusion. And here's how. 26 recommendations in here tell them how to do that or to start doing it. In fact, this report goes further. It says that without regulation, innovation that's needed to increase financial inclusion cannot thrive. That's why this is a major piece of work that we're very proud of here at the Centre. CGD Senior Fellow Liliana Rojas Suarez is the co-chair of the high-level task force that produced this report. She'll take us through a few of its main points in a few minutes, and then we'll hear from members of the panel about its different aspects. First, we are delighted to welcome Marisa Largo, Assistant Secretary for International Markets and Development at the US Treasury. She's going to talk to us now about the US view of financial inclusion and of financial regulation, and what the US can do in this space. Assistant Secretary Largo, I invite you to the podium. Thank you very much.
Thank you, Rajesh. And thank you for inviting me to the launch of this report. I'm especially pleased to be here to address this topic since both financial regulation and financial inclusion are topics of keen interest to Treasury, but also to me personally. They both fall within my remit. And kudos to the task force and for CGD for realizing the power of bringing these two topics together. I've been struck by the common sense but powerful nature of the report's 26 recommendations. As I mentioned before to some of your future panelists this afternoon, I agree with many, I'd say the large majority of the recommendations. There are others that I don't fully agree with, and that's a good thing, because a center like CGD should always be pushing the boundaries. Were I to agree fully with all of them, I'd be faulting you for not going far enough. And you can guess which ones fall into which category. But as important as the recommendations themselves are, the debate and the discussion that they'll engender among policymakers and regulators alike are going to help us understand the options that are available. They'll give us exposure to different approaches, and ultimately, a report like this and the recommendations will inspire us to continue to improve our financial system. Expanding financial inclusion is a high priority for Secretary Liu and the Treasury Department. In fact, just last week, Treasury hosted a symposium on women in finance and technology. This symposium, which was the 6th time that Treasury has hosted a Women in Finance event to celebrate Women's History Month, featured senior executives from across the finance and technology sectors. Now, they ranged from the more traditional firms like Visa and MasterCard to newer technology-driven firms like Google and Facebook, and even included some of the newest entrants like Square. And each of these institutions was represented by a very senior woman in their management hierarchy. Now, in his remarks, Secretary Liu emphasized the importance of innovation to financial inclusion. He also stressed a belief which he has repeated in private meetings, in public settings, in congressional testimony, that advancing inclusion and protecting the financial system from abuse are complementary goals. So Rajesh, entirely agree with the way you teed it up at the beginning. By enabling more people to benefit from access to the regulated financial sector, we can reduce reliance on informal services, and this increases the transparency of the entire financial system. Now, to state the obvious, increasing access to financial services, whether simple transaction services, saving opportunities, credit, or insurance, can improve the lives of many people throughout the world, but also here in the United States. This isn't just an issue for the emerging world. It's a big challenge. Being from Treasury, we like statistics, and so I'm going to quote a World Bank statistic that estimates that more than 2 billion people around the world currently rely on cash to manage their daily needs. Now, at the individual level, increasing access to financial services can improve a woman's ability to weather shocks, to build financial security, and invest in her future, whether that's by taking out loans to send her children to school or to start her own business. But let's step back at a societal level. Expanding financial inclusion will foster more inclusive growth, and it will also bring more transactions into the regulated financial system, which is good for both financial stability and for monitoring risks, which again, as Rajesh pointed out, are two core features of financial regulation. As the report notes, technology offers great promise for expanding financial inclusion. The new technologies are so rapidly changing the face of financial services across the globe, allowing the financial sector to reach more people in more remote places at lower delivery costs and with higher quality than ever before. That's a winning combination of features. Now, critically, from a government perspective, digitization of financial services can improve transparency and traceability of financial transactions, which is crucial both to the service providers but also to the regulators. Digitization has also reached into government payments. Now, why would a country want to digitize its public payment schemes? Reducing costs, increasing transparency, reducing opportunities for leakage, and encouraging the uptake of regulated accounts by its citizens. One example that we frequently point to is Fiji, a small island nation. 5 years ago, it digitized its social welfare payments, providing its recipients with a very basic transaction account along with a debit card. Welfare recipients who were previously underbanked, and most of whom are women, now have access to 25 times more electronic points of service than they had before the digitization. And encouragingly, the recipients are increasingly using their accounts for a range of purposes and not just immediately withdrawing their entire allowances. We've also seen the benefits of digitization in Mexico. By switching to digital payments of government payrolls, pensions, social benefits, the Mexican government estimates that it's now saving over $1 billion annually. That has little to do with regulation and a lot to do with the government's bottom line. And I've also got to put in a plug for what we're doing here in the US. Through our Direct Express card, we've digitized payments, reducing costs of accessing and using benefit payments for almost 5 million Americans. Now, in addition to expanding access to accounts and saving government funds, digitizing government benefit transfers vastly expands the volume of payment transactions. This, in turn, helps grow the market for payments and makes the business case for the private sector to come in, to innovate, to invest in commercial services, to reach even more people. We know here in the US that we believe that government can set the stage, but we pride ourselves on the innovation and the entrepreneurship of our private sector. Now, technology is helping financial inclusion in another way, which is by facilitating easy and affordable identity verification. In developing countries in particular, identity verification can be a hurdle, both for the providers who are trying to bring on new customers, but also for individuals, and most especially women, who are trying to open an account. As the report notes, the Indian government is tackling this challenge through Aadhaar, their national biometric identity number that has already reached over 1 billion Indian citizens. Now, taking the next step, recent Indian legislation now allows Aadhaar to be used to verify identity, including at banks. And that's a step that should enable a dramatic increase in access to financial services. Nigeria is another country that's addressing identity verification for its citizens. Again, the report notes some of the challenges that Nigeria faced in its earlier attempt to roll out an identity verification system, but the government is now partnering with a private sector card company to provide identification cards to millions of Nigerians. While initially the card is intended to serve solely as identification, in the future, these cards hold the possibility of being activated as functional credit cards, providing access to this additional financial service. So I'll now turn to the second pillar of the report, which is financial regulation. To succeed in harnessing the power of technology to expand financial inclusion, we have to make sure that our regulatory structure is keeping pace. At the most basic level, as Rajesh said, regulators protect consumers, but they also guard against this broader array of risks, ranging from risks to financial stability to money laundering and terrorist financing. As new technologies are changing the nature of financial services and bringing new people into the financial system, regulators play a crucial role in ensuring that new products and services are safe both for the consumers, but also for the financial system more broadly. In doing so, regulators have to balance addressing our safety concerns with encouraging innovation and not inadvertently squelching promising new services. And I'm so pleased to be looking out at you, Governor, who has just led the way in showing how an enlightened central bank can truly be a game changer. As the report rightfully indicates, regulations should be appropriately tailored according to risk, and in particular, the risks associated with the services being provided, but also the scale at which they're being provided. And the report also highlights the critical role of timing. Now, in some cases, changes in regulation ex ante can help open up the market for new providers and services. But in other instances, regulators very appropriately might prefer to allow new providers and services to innovate, to enter the market, and then implement the regulations ex post. With these dynamics at play, there's no question that fostering financial inclusion presents some significant challenges to us as regulators. And at Treasury, we're focused on 3 of them. And certainly, Rajesh, you and the report have previewed them. The first, protecting consumers. The second, regulating new providers. And then the third, implementing risk-based customer due diligence programs. So let's start with protecting consumers. The report hits the mark. We have to work to avoid fraud and abuse, but at the same time also ensure that consumers are getting the greatest benefits possible from the newly available financial services. What are the necessary protections? Well, they include full transparency around the fees that are being charged, making sure that consumers understand their rights, assuring that consumers' funds are protected and insured, and providing simple, fast, and accessible recourse when problems do occur. Now, turning to the second area that regulators are thinking about. When I refer to regulators, I mean both central banks and standalone banking supervisors. These regulators have traditionally focused on the supervision of banks rather than non-bank payment providers. With the emergence of established non-bank providers of financial services, be they microfinance institutions, credit unions, postal banks, the regulators have the emergence of these institutions have already stretched the boundaries of what traditional bank supervision does in many countries. And then if you layer on top of that the growth of new types of payment providers, e-money providers, mobile money operators, new niche payment banks, non-bank agents, virtual currency payment systems, there is an awful lot of work to be done to develop regulatory systems and tools that provide adequate insight into their activities, and again, without squelching new innovation. As regulators around the world have learned with the microfinance industry, it is very, very labor intensive to monitor many small providers, each of which is using a different and rudimentary reporting system. Another challenge is ensuring that these new providers have appropriate access to payment systems, but in a way that doesn't allow them to undermine the overall integrity of these systems. And as the report notes, coordination across a broad array of regulators is essential, and this is most important when the financial services are being offered by telecommunications providers that operate wholly outside the ambit of traditional bank regulation. Now, another regulatory area on which Treasury is focused, and the topic that I'd like to explore in a bit more depth, is implementing a risk-based customer due diligence program. I'll use CDD for short. CDD, such as transaction monitoring and record keeping, protects our financial system from abuse by money launderers and financiers of terrorism, helping advance very important law enforcement and national security goals. When the money laundering and terrorist financing risks posed by particular products or services, transactions, or delivery channels are low, and when there is a low risk associated with the types of customers, countries, or geographies, then Treasury has supported countries when they've adopted a risk-based approach that allows for simplified or so-called tiered CDD. Tiered accounts with strict limits, such as balance, deposit, or withdrawal caps, and coupled with transaction limits, control risk by their very design and potentially permit the use of simplified CDD. This risk-based approach is supported by both FATF, the Financial Action Task Force, but also by the Group of 20's Global Partnership for Financial Inclusion. Treasury is an active participant in both of these institutions. Now, a challenge remains. Despite the flexibility that is afforded by FATF and its approach, many countries remain uncertain about how actually to design and implement a risk-based approach to CDD. And this can lead to overly rigid national regulations that, in turn, make it hard to reach low-income customers. Mexico is one country that has taken a proactive approach, introducing a tiered CDD regime in 2011. It has varying requirements depending upon deposit and balance thresholds, as well as whether digital person-to-person transfers are allowed. At the lowest level, at the lowest tier, level 1, a user can open an e-wallet account without identity verification. The account holders can use their e-wallets to withdraw small amounts of cash that can be used to pay for goods and services, and they can receive remittances from certain jurisdictions that are lower risk. The financial services institutions that offer these level 1 e-wallets are themselves subject to streamlined record keeping and reporting requirements. They provide periodic monitoring, which is aimed at even further reducing the risk of money laundering or terrorist financing. Now, I'd like to take an ever so slight diversion from the core topic to address an issue that Rajesh mentioned, and that is front of mind for many of us who are involved in fostering financial inclusion, and that's de-risking. Different people have different definitions of the term. At its core, I think about de-risking as a decline in correspondent banking relationships and a loss of access by money service businesses to banking services in certain countries. We know that correspondent banks and money service businesses play an important role in channeling financial resources both within economies and across economies, and in doing so, they help us further our financial inclusion goals. So Treasury is committed to addressing concerns about de-risking in a way that accomplishes our joint and, as Secretary Liu would insist, complementary goals of enhancing financial inclusion and protecting the financial system from abuse. We are well along in a 3-point plan to address this de-risking issue. The first thing we're doing is we want to bolster understanding of de-risking through better data collection and analysis. The World Bank last year did a groundbreaking piece of work, but it was surprising how very little information we have about the de-risking phenomenon. A lot of anecdotes, very little hard data. The second thing we're focused on, and this is working both among US and other major countries' banking supervisors, but also FATF and the Financial Stability Board, is improving communication about existing guidelines that address anti-money laundering and countering the financing of terrorism, AML-CFT. And then the third is recognizing that it is incumbent upon us, the US and other developed nations, to support implementation of AML-CFT regimes by countries around the globe in order to enhance the confidence of US banks in the AML-CFT programs of their correspondent account holders. And as I said, Treasury is working very closely with both FATF and the Financial Stability Board. I think it's quite significant that a group focused on financial stability has recognized the importance of coordinating work on this issue of de-risking. Now, I'll end by noting that the challenges identified in the report require capacity building in countries around the world. Treasury is working to help other countries build up their capacity, their expertise to face these challenges through bilateral technical assistance that's provided through Treasury's Office of Technical Assistance, OTA. OTA works with our global counterparts, be they finance ministries, central banks, revenue authorities in emerging markets around the world. Our technical assistance is exclusively focused on what we know best as a finance ministry, and that's public financial management. Now, this ranges from designing government debt programs to enhancing bank supervision. But more directly relevant to the report, OTA works hand in glove with bank supervisors and financial intelligence units to help our partner countries strengthen their AML-CFT regimes. Interestingly, in the past few years, we have gotten more and more requests from our client countries to ask whether we can provide technical assistance to countries that are looking either to roll out for the first time or to enhance their financial inclusion program. And so we have expanded our program in this area markedly because we welcome this interest on the part of emerging market countries. So let me end where I started, which is once again thanking and complimenting CGD and in particular the task force for a report that we found to be timely, thorough, useful, and thought-provoking. And we certainly look forward to working with the folks in this room and CGD in implementing the report over the coming years. Thank you.
Thank you, Assistant Secretary. I'm going to ask you if you'd mind sitting there just because of where your microphone is placed. Thank you very much, Assistant Secretary Largo, for your kind comments about CGD and the report.
Marisa, please.
Marisa. If I could just remind people to silence your phones, that would be very grateful. I can't call you Marie, so I'm going to call you Assistant Secretary. It seems a bit more polite. Assistant Secretary, Treasury has said inclusion and protecting the stability and the integrity of the financial system are complementary goals, and that increasing access to the regulated financial sector increases transparency and, in fact, the safety of the entire system. But the point is it has to be regulated, right?
Regulation is important because in the absence of sound regulation, money will flow. We see that with remittances. So we shouldn't kid ourselves that if formal payment systems are stopped, are stymied, that money isn't going to flow. Having these flows go into an unregulated, into a dark system, benefits no one. In addition to it being dark and being able to be exploited for ill, there is also the issue of leakage, that when payments go into the underground system, there is very little information about what the costs are, where portions of the payments are being diverted. And so I do think the challenge is finding the right level of regulation that, one, recognizes the risk, that the risk of a $4 billion transfer payment between two mega banks is very different than the withdrawal of $20 from an ATM or the sending of $100 to one's relatives in the country of origin. Again, it is not just one part of the financial system. As we regulate, we always have to think about the role of innovation, and that applying a rigid supervisory structure can squelch the innovation. And again, certainly speaking as a representative of the US, we pride ourselves on the fact that our industry is always out ahead of the regulatory structure. We shouldn't be left too far behind. We have to keep it within shouting distance, but the innovation is absolutely essential.
Shouting distance, yeah. They may not be listening, but shouting distance. Just on that point, there are examples of how governments have led the way in adopting digital payments. Right here in the US, you have the Direct Express card for benefits for 5 million Americans. In Fiji, you digitize social welfare payments. Now, this can grow the market for such services. It creates space for private innovation, but often governments are not the early adopters. They're the kind of laggers. They lag behind slightly. So in that instance, what's the role there?
I think it is, one, as I said, to be aware of what is going on. Second, to encourage it, to recognize that innovation is a positive. We may not know what is on the horizon, but we certainly realize that our current system, if it remains as it is not serving too many members of our society. Now, governments can take very different roles. One is a more passive, let a number of innovations bloom, let the market sort out. Again, always with an eye towards what the risks might be. A second could be a forward-looking government, and again, Governor, I look at you in recognizing that an industry is beginning to emerge and that current regulatory constructs may inappropriately be weighing too heavily on a newer technology, a newer approach to providing financial services. And so at times it is actually tailoring existing regulations to get them out of the way of needed innovation.
This is what the report describes as the balance between ex ante and ex post regulation. In terms of the work that the US is doing, in developing countries, it's through Treasury's Office of Technical Assistance to help build capacity for innovation and to grow the market in digital payment services. But how do you kind of decide what comes first, the technical assistance or the regulation?
The chicken and the egg issue. Yeah. I actually think that they absolutely go hand in glove. And I would stress that it is actually a Treasury-wide initiative. It is our Office of Domestic Finance working with our major banks that provide so many of the correspondent banking services. It is the super important work of Treasury's Office of Terrorism and Financial Intelligence working through the FATF to make sure that the FATF rules are appropriately tailored and understood. But on the balance between technical assistance and regulation, much of the technical assistance is actually provided to entities that are looking to enhance their regulatory structure. So I don't see that you can afford to say, let's stop, we'll provide technical assistance. It's not a static world, and so we work hand in glove. Also, the knowledge that we learn from one country, we are then able to share more broadly with other countries. And I do think it is especially important for someone from the US to say, we learn from our partner countries. It's not that we have a lock on the knowledge about how to provide financial services to reach the broad population. There is an awful lot of learning. I, again, don't want to steal your thunder, but M-Pesa is studied the world over as a model that has lessons, not just for other emerging markets, but for the developed world as well.
And we will be talking about M-Pesa a little bit more with Njuguna Ndungwu, the former governor of the Central Bank of Kenya. But let's think about this idea of regulations, which is what this report is about. You've talked about technical assistance, but what apart from technical assistance can advanced economies like the US do to help countries design regulations that will marry these goals of financial stability and inclusion? What are your ideas for the kind of regulations that we could see?
I think the regulations, again, are going to be tailored to what the needs are in the particular country. So the notion that there's a one-size-fits all is incorrect. I also think that we have a special responsibility as major shareholders, major donors to the World Bank and the regional development banks. They have a far larger footprint inside the countries that are looking to foster financial inclusion. And so making sure that, one, our efforts as shareholders support the banks as they reach out in this arena. And I'm very pleased that the banks are at the forefront. But the second is also coordinating technical assistance. There are many providers of technical assistance, and there is more demand than there is supply. So it is particularly important that we be efficient and coordinated and not be tripping over ourselves.
But that's back to technical assistance.
Yes.
Let's think about designing regulations and designing the kind of things that this report is talking about. How can the US lead in that? Where can the US lead in that?
Well, I think we lead through our role within FATF. FATF, again, is not just a body for wealthy countries. It is a body that encompasses countries around the world, and making sure that the top body, learns from its regional bodies, which are much more attuned to the reality in their particular region. And second, modifies its standards, which are the gold standard for protecting against money laundering and terrorist finance, that it, one, modify them to reflect risk, but as importantly, and this is something we're particularly focused on at Treasury, is communicate what is required. Make sure that our banks understand what we expect of them and that they don't impose an inappropriately high hurdle. Make sure that we are crystal clear about what is required so that risk is monitored, but innovation and payment of legitimate financial flows aren't squelched.
Talking about that issue of AML-CFT, anti-money laundering, combating the financing of terrorism legislation, for which we'll probably never ever find a better, shorter acronym. Are you suggesting that we're likely to see changes in US policy on this front?
Not so much changes as clarification. I think the focus on de-risking, the discussion around de-risking, has brought to the fore that what we say and what our banks at times hear may not be the same. And so making sure that there is a very clear understanding that we are not looking for zero risk. That is absolutely unobtainable or obtainable at a price of just shutting down financial flows. And so I think what you will see is heightened communication. We may need to rely on folks like you who are the expert communicators to get the message across about risk-based due diligence. Not all transactions are the same.
Our door is open. We'll be happy to help. I know you have to leave shortly.
You are incredibly good partners to us. Thank you.
Thank you very much indeed. Nancy Birtle, present right there. I know you have to leave very shortly. Let's just ask you one more question. Financial inclusion. It's an area of focus for the G20. As I said in the introduction, it's a buzz phrase. It's a really important element of the Sustainable Development Goals and the 2030 Agenda. What do you hope to see the G20 come up with this year in this area, and how can this report help?
The report helps by shining a spotlight and getting more and more people talking about it. I also want to repeat something that Secretary Liu mentioned yesterday. He had a meeting for a large group of staff and pointed out that it is very easy in the last year of an administration to say, oh, either going to coast or we'll just cement what we've already accomplished. But it's not just the secretary. From the president on down, there is this commitment to seeing how we can move the needle on financial inclusion, because it's an area where we don't need legislation. The legislation that we have is adequate. I think what we want is to, where I would hope that we could get by the end of the year, is have a broader array of folks within the US recognizing the importance of financial inclusion. Better clarity and better dialogue between government and the regulated institutions about what is necessary, and financial institutions that have upped their game on their CDD, on their AML CFT screening processes, so that they are comfortable that they can take on more risk because they have better processes. At that point, the net result of it, I would hope, would be improved, quicker, and cheaper flows to emerging markets, because that ultimately, the bottom of the pyramid within our country and in emerging markets, is where we want to end up: safe, reliable flows.
But that complexity and that coordination of understanding within the American system, how do you take that to the G20? What do you tell China?
Actually, China has been a magnificent partner in this. This is China's G20 year, and we, the US, are very invested in seeing China have a successful G20 year. So we were quite pleased when they came and said they wanted to have financial inclusion be one of the themes. So this is pressing on an open door.
Okay. On that point, Assistant Secretary Marisa Lago, thank you very much for joining us here at CGD this afternoon. Thank you very much indeed. Thank you. Right, while my assistants reset the stage very briefly, I'm going to invite the report's main author, Liliana Rojas Suarez, to come up to the podium to take us through some of the main findings, and then some of the members of the high-level task force will talk about some of the main aspects of the report as well, and then there will be time for questions from the audience as well. Liliana, take it away.
So are we...
Do we have Liliana's presentation? There we go.
Well, thank you. Rajesh and Marisa has actually made my job much easier because already a good part of the discussion of the report has already taken place. So let me tell you just a little bit about what this is all about. Many of you are interested and know about the topic of financial inclusion, and you all know how many constraints for financial inclusion are there. So it's not surprising that our ultimate goal is to improve financial inclusion, especially digital financial inclusion, because of all the benefits that the new technology can bring about. But the real question is, why are we putting the emphasis on regulation? And the truth of the matter is that, as Marisa mentioned, of course, without certain rules, there is no way that a number of innovations are actually going to come to life ever. Like many countries require regulation that allows for electronic money to actually be delivered. But even more importantly than that, when you address the regulatory community and you ask them, all right, what is needed in your menu to raise the level of financial inclusion to the level of your other mandates? The first thing that a regulator is going to answer, especially conservative regulators from well-managed countries, are, well, you know, my mandates are to maintain the stability of my system, the financial integrity, and to protect consumers. So we had that in mind. And so we said, okay, how do we build a report that take into account those constraints and questions from the regulators? So we said, okay, why don't we build a framework that actually based its most important components on the basis that regulators are used to talk about? So the principles on which this report are based are simple and straightforward. The first two are used by bankers and by banking system regulators around the world. The third one is more broader. Let me get a little bit into those. The first one is similar regulations for similar functions. Very well accepted. It doesn't really matter who's providing the service. if the function of the service is the same, well, the regulation should be the same. There's no argument with that. There is also no argument, and the Basel Committee would be the first one to talk about it and to support it, is that regulation should be based on risk. The riskier the service or product that is offered, the higher, the stricter the burden on regulation. So far, the financial regulators around the world will feel very comfortable with this. The third one is one that is not that much used in the financial sector, but is used in all other industries in the world. And it's the balance between ex-ante and ex-post regulation. Critical. Ex-ante is clearly what are the rules that are set to basically tell you, okay, if you follow these rules, that's the way the system is going to operate. But ex-post is, okay, I may not know how this industry is going to flow, how it's going to evolve, and therefore I'm going to reserve the right to actually intervene if necessary, okay? Based on those three principles, and that's why I really encourage you to read the report, because you are going to see how those three principles come to life into our regulation recommendations, we focus on three areas: competition policies, level the playing field, and know your customers. And I'll quickly move throughout them. First, on competition policies. Okay, there is no argument again that competition policy matters enormously for financial inclusion. Basically, of course, if a market is open to fair competition, well, that would include the number of potential consumers that are currently in the sidelines. You will have more providers that come into the system. And also, because of competition, there will be more incentive to actually start looking for what are the needs of the underserved, what are the products that should be designed for them. So the goal of the recommendations that are in the report is to allow the entry of new, underlying, qualified providers of financial services, but without deterring possible corporations that the system can actually produce. And why the emphasis on cooperation? Let me give you an example that Marisa also mentioned. Interoperability, a word that I hadn't heard before and now is in my everyday language. But of course, what it basically means is that being different networks between either banks, ATMs, mobile networks, whatever, they talk to each other. A user of one network can send transfers to a user of another network, do business between networks. Okay, but the issue is, should it be mandated? Should it be part of the regulatory ex-ante? Should I say, okay, you should start with being interoperable? And the answer is no. What happens is that because these new technologies are evolving and there are new players coming on, if you actually start by mandating interoperability since the very beginning, you could actually cut innovation. You could actually cut the profit margins that at the beginning is small when the industry starts operating. So basically, our idea is that ideally, interoperability should emerge spontaneously, ideally. But if it does not, then the question that the regulator has or should have is, okay, what are the market distortions that are preventing interoperability from happening? And if there is a dominant player, is the dominant player putting more constraints to interoperability? Well, if I'm a regulator and see more constraints, my role is to actually stop those additional constraints. Therefore, if I keep moving down the kind of tree that we have here, the question really is timing. When do you mandate operability? And the right answer is going to totally depend on country-specific and circumstances. But what the regulator needs to have in mind at all times is neither too early nor too late. If it's too early, as I just mentioned, you could kill innovation and investment in the product you're actually trying to motivate. But if you are too late, then entrenched monopolies may actually not allow you to move forward. So just a quick example so that you get a sense. In Tanzania, for example, the IFC, the International Finance Corporation, facilitated the conversation between interoperability between the providers of mobile payment in the mobile payment market. And the regulator have already said that they would like it to emerge. But it was difficult to coordinate. So the IFC came as an honest broker and actually intermediated. And as a result of that, by early 2016, you do have interoperability among all the providers. That's one way in which it has emerged spontaneously. If we compare that with another example in Kenya, by 2014, the regulator, I mean you, was very concerned in that, okay, how long we have to wait until we stop having agent exclusivity. Basically, if you have, when you had M-Pesa, if a provider had a network of agents, the agent can provide only one of the providers, as opposed to one agent being able to service different providers. So something very interesting occurred. The regulator basically said, all right, I'm going to mandate interoperability. But before it actually mandated interoperability, the industry reacted. Immediately, the largest player, which is called Safaricom, reacted, and interoperability between agents actually was allowed to happen. So in one case, it emerged. In the other case, it's exposed regulation, but it actually, there are alternative ways, but these are examples of something that really happened. What about level playing field? Level playing field, by its sound terminology, tells you all about what it is, right? You have so many different providers and new providers, new modalities, new technologies. Everything is kind of new. And not only the providers are new, but also there are so many regulators. You have to involve the central bank, the supervisor, the telecom regulators. So how are you actually going to make that you are in a level playing field where people compete under fair basis? So the goal of the report in this area is to prevent that regulatory actions actually distort the level playing field. Actually, by regulation, I could actually easily make the level play and the playing field unleveled. One example, Indonesia, so that you get a sense of how you actually could have a level playing field. In Indonesia, by regulation, only large banks can use as agents mom and pop's small shops. Neither small banks nor mobile network operators are allowed to do so. But that's by regulation in a country where has a high mobile phone penetration, but it's not allowed to use its networks. And so easily this can be changed, okay? So that is an example of an unlevel playing field. Leveling playing field from our perspective implies then that you basically treat equally functionally service the same, but it also means that if the service is riskier, the burden of regulation has to increase. So you do not treat in this say ladder of regulation that goes from the bottom to the top, you don't treat the same in terms of the burden of regulation, payment services, or credit. Payment services that are only involving or are associated with very simple transfers can be regulated at a much, I'm not going to get into the specific recommendations, we can go into that in the discussion, but the burden of regulation can be much lighter. If you start increasing the sophistication of the product or the risk involved to the system, for example, what if I actually am not a bank, but I'm offering deposit kinds of instruments, like electronic wallet, right? In that case, should I be concerned about, because that is what I'm offering, that's the liability side of the institution, should I be concerned about the asset side of the institution? What is the institution have to protect the consumer from the product that I'm offering? So issues such as a trust account, deposit insurance, all those questions start coming, and of course involve regulation. And of course, without doubt, if you actually move up the level of risk to providers of credit, now you're talking leverage. And when you're talking leverage, you're basically offering services that are like banks. Banks are characterized by offering leverage. Well, if you act like a bank, then you should be regulated like a bank, okay? So that's kind of the idea of the whole spectrum of recommendations under level playing field. Finally, know your customer, an issue that has been underlined and stressed by Marisa Lago several times. Well, know your customer rules can have positive and negative effects on financial inclusion. On the positive, of course, you are going, the more you know your customer, a provider know its customer, is going to be more willing to offer an ample range of financial services. That's true, right? I mean, if I don't know my customer at all, I'm going to be willing to offer just perhaps transfer or whatever. However, if we have excessive know your customer requirements, then providers might find it too onerous to deal with the poor. Because can you imagine if I have a very large amount of regulations that affects both a large consumer, a customer, let me use customer better, versus a small customer, I'm going, and I have the same level of regulatory burden. Well, why would I serve the small customer? I'm going to go for the large customer only, okay? So the goal of this set of recommendations is to design know your customer rules that are adequate to the task of maintaining financial integrity, but without creating unnecessary barriers for financial inclusion. And here, this is a way, and with this, this is basically a way to round up the way we're thinking about the recommendations, is that you have two goals. And the two goals is that you want your system to have integrity. And at the same time, you want financial inclusion. Well, it's well accepted that the approach to that, and Marisa Lago raised that issue, is to use the risk-based approach. And this is well accepted. But for that, and the reports make an enormous emphasis on this, the things will be much easier if you have a strong national identification system. It will be much easier, especially if you go the biometric way, and there is a whole section in the report that talks about that. And of course, and Marisa Lago mentioned this to you, the Aadhaar example in India is a very good example, especially for one characteristic that now is being used, and that Alan Gelb in a paper advances quite interestingly, and is that the Aadhaar now is actually helping to use financial inclusion as a carrot rather than a stick. What do I mean by that? I tell you, you can open an account now with a restriction. The restriction is that later on, you're going to show proof that you have registered in Aadhaar, that you have an Aadhaar. So basically, you're using it as a carrot to attract the usage of Aadhaar. And so this is actually helping multiple goals. So if you're focusing on the risk-based approach, if that's what you have in mind, then the recommendations flow. You are supposed to have less onerous KYC rules for basic accounts because, you know, if you have a very small amount of money with limited balances, limited on withdrawal, limited on deposits, the risk to the system is going to be really small. And actually, basic accounts are now being used in a number of countries. India is, again, one example. Peru, my own country, is another example. But then we have, and again, I'm selecting, right, among the large number of recommendations in the report. But then we also would like to see graduated penalties. What do we mean by graduated penalties? You know, really, if you believe in the risk-based approach, you are not supposed to be punishing providers for the number of violations, especially if the violations are for very small amounts. The truth is that what you are asking the providers to comply with is with certain due diligence. So I tell you, this is what you are supposed to do, and if you do it, then I cannot expect to eliminate fraud altogether. I need to allow for fraud to have some margin of error. So the graduated penalties imply that you increase the penalties by basically failure of complying with the due diligence requirements, as opposed with the number of violations. Of course, as you become a serial killer, if you are violating over and over and over again, then you're actually moving to a higher level of risk, and therefore graduated penalties imply that you will be subject to greater penalties. So this is a roundup, a very brief condensation of the report and of the areas that we are focusing on, and the specific recommendations actually, as Marisa said, are not intended to have the last word on, okay, every country should be doing this and that, but to serve as guidelines on the direction of recommendations that regulators should follow if financial inclusion is going to be achieved. Thanks.
Okay, thank you very much, Liliana. So my colleagues are now going to come and reset the stage, and we're going to invite the panelists up so we can move to the discussion part of the event. We're running a little bit over. We're going to keep it going, keep a good pace, and we're going to get questions in as well. And don't forget to tempt you all to stay for longer. We do have some refreshments at the back later on, not before the event is finished. So if I can invite my panelists up to the stage, I'll introduce them as they come. Liliana, you already know. Just stepping up now is Stein Claessens. He is the Senior Advisor to the Federal Reserve Board, formerly from the IMF, and the co-chair of the high-level task force that put together this report. Njuguna Ndungu has already won the plaudits of Marisa Lago today, the former governor of the Central Bank of Kenya, who oversaw the rollout of the M-Pesa system, and our very own senior fellow here at CGD, Alan Gelb, who, as many of you already know, leads the field in how biometric identification can help achieve several of the SDGs and also improve financial inclusion as well. Panelists, thank you very much indeed. Stein Claessens, let's start with you. Liliana talked about how similar functions should attract similar regulations, but also this idea of a ladder of risk. If you just offer payments, small amounts, it's pretty low risk. But as you start offering more services, or as the amounts grow bigger, it becomes slightly riskier. So in your view, what further types of regulations should be imposed on companies that go beyond basic payments, that go, that offer things like savings or credit? As you go up that ladder of risk, what further types of regulations do you think should be imposed?
So two things. Level playing field is something about horizontal, right? So that we regulate all the same agencies, the same service, the same way. So whether it's offered by a bank, a payment service, or by one of those new technology, what we call digital service providers, they should be regulated the same. Now, if we go up the ladder, we have to regulate more tightly. So deposit is regulated among many countries, often in the banking system regulation more tightly, because it has risk to the user. I mean, the money can be stolen, the money can disappear, but there's also other requirements in terms of record keeping, so that if there were to be a problem, that you can go back to it. And that's what we mean by the ladder. As these risks rise, we want the regulation to be tighter. And the challenge is it's kind of a matrix, right? So you have the level of the services that you want to regulate horizontally, and they have the ladder going up. Some institutions offer more than one services. So for that reason, they're going to be more regulated more tightly. And that's where the new digital is going to be a little bit tricky. We know the banking system quite well. We don't know yet how to do it on the digital side perfectly.
What types of new regulations?
Well, not necessarily new regulations, because we know from the banking side quite well how to regulate. But we may want to start very simple, for example. One of the proposals we have is that if you have a new entry of a digital service provider, and that's offering some safety in terms of a stored value, what we call it a deposit, but it's really kind of a stored value, that we're asking that digital service provider put the money in a safe asset. A highly liquid safe asset could be a government bond or something like that. That gives security and safety to that user of that service without putting on all the apparatus of a banking system. Now, if the provider wants to go further and says, well, I do want to offer all the other services and I also want to provide credit, that's fine, but then you have to go for the banking licenses.
Do you think that might put some companies off getting into the market?
Well, we do it for the good reasons, right? So because the risk involved, the risk to the consumer, the risk to the financial system as a whole. So for that reason, it would be imprudent to say, no, it's fine, you can do whatever you want. We don't allow countries, or most countries don't allow banks to open them up overnight, right? You have requirements on what is a prudent person, do we trust them, does he have the systems in place, but very importantly, does he have risk management in place, and where he's investing the money in. And if we allow the DSPs, the digital service provider, to do some of the same things, we're going to have to regulate them in the same way. That's back to the level playing field that has to have a risk dimension to it as well.
Yeah, just to add and clarify a point, it is very important to stress that we are not adding more regulation. We are using, the reason why I start presenting the framework is because we are using the toolkit that regulators have already been using in the banking system as well and in other industries, and use that toolkit in a smart way when you think about financial inclusion. So it's not additional regulation that we are saying, okay, let's put more burden here, more burden there. No, it's the way you frame the regulation and when and how you apply it.
Njuguna Ndungu, the former governor of the Central Bank of Kenya, you oversaw the rollout of M-Pesa. And in fact, ladies and gentlemen, Njuguna and I recorded a podcast about that about this time last year. Yeah. In fact, I think it's on our website, cgdev.org, if you'd like to check that out. Njuguna, though, tell us, what has Kenya managed to do in terms of encouraging competition in digital payments beyond M-Pesa, and what are the challenges that you've experienced there?
First of all, let me go back to the issue about regulation here, because essentially I talked about introducing a digital financial system, which was, the entry point is actually improving the payment system, but we didn't have a legal framework. And that is perhaps more pertinent to the questions that was being discussed here. There was no legal framework in terms of the payment system. And as the legal framework was improving, then obviously we now get into a situation where we have a law that actually allows for payment solutions and even payments kiosks. But we still find ourselves at a situation where it is the banks that hold all the resources, all the financial resources. That is the store of value is with the banks. And that is where the situation is. Let me come to M-Pesa itself, because that's the question you asked me about rolling out of M-Pesa. One of the things is that, where is the starting point? The starting point was, how do you make small payments, loan repayments, and the distance you cover is much more, is higher. The cost of getting those payments to the banking, to the microfinance is much higher than the loan payments you are actually going to deliver. So the basic idea was actually to use prepaid airtime. But what I think, I'm developing this case study on M-Pesa. What the starting point was, the communication law that allowed or recognized electronic units of money. So in a sense, what we saw in Kenya was the telecoms are helping us transform cash into electronic units of money and store it in the banks, in a trust account. And that is where now regulations was now saying, how do you, first of all, ensure this transformation, the transmission, and then the storage of value is where the regulations in the banking sector is, the central bank was quite comfortable with the regulations. And that is how the setting is, and that is how the novelty of the whole thing is that there are two stages that we're going through: cash into electronic units of cash, the transmission to a bank account, and then all of a sudden you regulate the bank account, there's the communication authority regulates the telcos, and everything is fine. So the agents that you see around that belongs to the telecommunications are actually like shopkeepers. They're just transforming cash into electronic units of cash and simultaneously loading it into the SIM card on one hand and on the trust account on the other. But as we said, different countries with different legal jurisdictions have different problems in terms of how to go through that simple process as we saw it ourselves.
You make it sound so easy. Why is it then that other African countries have not been able to follow Kenya's example?
You know, in the English common law, it was very easy to to invoke, because we didn't have a legal framework for payment system. Don't forget that in Kenya, the added mandate of making sure that you have a payment system that is effective and efficient just came up in 2003, and there was no legal framework. So essentially, the legal framework was started to be developed. That's on the one side. That is how we faced. But then, in the end, when this product hit the market, the only way was to let's use the trust role. By invoking the trust role, the process is that you're going to have trustees. Those trustees, we are going to have a trust account. That trust account has trustees and all that. And that ensured that the product is developed jointly by the telecom and the commercial bank. So it's a commercial bank product, and that is where the difference came in. But if you don't have that kind of law, and we had a conference last month in Oxford, we realized that some countries have used the escrow account. Others have used the fiduciary kind of system. Now, that's why the recommendation is actually showing that, look, if you are using like an escrow account, it means you are storing value outside the banking system. And that's why there is a recommendation that is touching on that. So different countries have found it difficult. Those countries that have decided to go in a, should I say, innovative way of trying to look at solutions, they have gone into all these aspects because they cannot easily go into or use the strength of the trust law. Yeah.
Thank you. Alan Gell, your work on biometric identification, is well known here. It fits squarely into this topic. And Marisa Lago was talking about the importance of identification, knowing your customer, part of the recommendations. But the more information that banks have, then the more services they'll feel confident to provide. But how realistic is it to expect a lot of information, especially identification information, from people who are living in poverty in poor countries?
Okay. Well, Rajesh, I think the main thing is to recognize that the cost of gathering and processing information is quite high, especially when it involves dealing with individuals. So you have to minimize that. And the position in the report is that for very small accounts, you can't go through the whole range of KYC requirements, knowing the business of the customer, what they're going to be doing with the money, what kind of relationship you're going to have with them. Maybe the best you can do is to be reasonably sure of who they are, and maybe have a mechanism so if you have a small account, you don't have someone with 2,000 small accounts which is disguising the pattern of movement through the financial system, things like that. So it really gets back to the question of customer identification and verification, which is a subset of the whole KYC apparatus. And for that, I think the main point that we were making is that if the government doesn't provide a mechanism for this, the banking system will have to develop its own, or the financial system will have to develop its own, which is happening in some countries, unfortunately. And the effect of that is to raise costs. It's very costly for a financial system to develop its own identification system. And so this will discourage financial inclusion. So we're suggesting that it's much easier if there's a strong base system, preferably a system, well, or almost certainly a system which sort of guarantees uniqueness. It has very strong controls against multiple identities. And if you have that kind of system, you can do a lot for financial inclusion. If you don't, it becomes very difficult.
Now, Alan and Njuguna, please.
Actually, you can still, all my life in Kenya, I knew I had an identity number. But the biggest problem was that, is it user-friendly? Is it accessible to, for example, the financial services providers? If you come with your ID, how sure am I, as a service provider, that this is the person who is there? Yeah. So like 3 years ago, I started working very hard and even pushing very hard the Ministry of Immigration to try and create this national database so that you can access it even from a banking counter. And that is what is really happening. So you can have the identification system, but if it's not accessible, then it becomes quite a problem. But maybe we are advantaged because of the fiber optic cable, internet is very available. But we need to emphasize that this is not only the identification system that is required, easy accessibility so that you can confirm this is the person. I can give an example that checks was the most fraudulent was actually issuing a check. Somebody will come up with a fake check and you don't know whether this person is the one indicated in the checkbook. in the check leaf. And all of a sudden it can manage to cash the check and things stop there. But if somebody comes in the check, the first thing is to ask, can I have your identity card? Then you can just punch in the number and you get the number. Everything works very well. So essentially, that's the system we are trying to push to the next level of saying accessibility at every point of service.
If I can just comment there, I think Kenya really is a very interesting case because Kenya does have a very strong identity system. It's a card-based system. And the next challenge will be to take it to the next level where we're actually identifying people, not cards. And so I know there's a discussion going on in Kenya about this, but in principle, it ought to be possible for a bank to be able to say, even if a person walks in without a card and just says, who am I? A bank ought to be able to do that like that. And I mean, technically, that is now possible. So I think this is where we have to look for the future if we want comprehensive systems. Not everybody likes that idea, by the way. But there is some discomfort in some quarters about that. But logically, if we're following this route, this is sort of where it's pushing it.
Stein Claessen's Marisa Lago talks about CDD, customer due diligence, and she talks about a kind of a tiered system. This idea that you could have restricted accounts, could have less stringent requirements. What are the risks of that?
Well, the risk on the KYC, so back to the money laundering, is of course that you have these small accounts and that people nevertheless use them. But otherwise, we should have a graduated system, for opening these accounts. It is no use to have all these requirements that we put in for a large amount that people are depositing for a very small amount. So that's the principle, and that's back to the risk-based approach. The risks are smaller, so you shouldn't have the same requirements. So you can come with a simple ID. Of course, depending on the country, that will have to vary a little bit. And then you can also put in the incentive. I think it has to be a story about incentives on both sides. Again, the India example is very nice. There's an incentive on the user to come up with more IDs as he goes through the process and wants more services. And there's an incentive on the bank in the sense of knowing more about the customer, because when I know the customer better, I can start delivering better services to him or her. So if you put those two things together, you really want a graduated system that only slowly builds up the requirements.
But what happens if companies fail to do their due diligence on knowing the customer? What should happen to them? This is to any of you.
Well, and Alan has with the most of this, even on the KYC, and it came back also in the presentation with the secretary, you want some penalties that are graduated but also set a priori. And I think there was a lot of confusion the last few years, and that's logical in some sense because we told these banks to be very strict with your regulation, otherwise we're going to be penalizing you, and that the banks, of course, in the presence of uncertainty, assume the worst and kind of don't do any of this kind of business. And I think now the dialogue is moving away from that and saying, well, okay, we understand zero tolerance is not something that we're going to ever get in this business. And we're going to treat you, as long as you have in place processes that take care of the risk in a reasonable manner, we're going to allow that to happen. If then something slips through, then that's par for the course, and so to speak, and we're not going to penalize you excessively for that kind of behavior. If you have that as a framing, I think we've come to the way of the risk-based approach that we really want to.
Do you want to chime in there?
The adherence to this process, for example, I think the study by Aaron Gelb is to show that Kenya's case has like a 3-tiered system for KYC due diligence. And one of the things that you can look at it is that the customer is duty-bound to conform. Otherwise, the system can shut you out. Just like we have restrictions in terms of how much you can transact. So even before we get to the service provider, the system itself can actually discipline the customer who is supposed to come and provide information at the basic level. I remember I used to have this discussion with the banks themselves saying, we have difficulties in the rural areas because beyond the identity card and maybe the RAD registration number, what else do we have? Can we change this format? And the format changed, but then that's where the tiered system comes in. So when it comes to transactions, especially the electronic transactions, you have to conform to those tiered approaches because it is the amount of, perhaps the risk-based approaches telling us that the best thing is to come up with such kind of system. Then the system itself can discipline both the customers and the regulator can now discipline the service provider.
Okay, I'm sure everyone is sick of hearing the sound of my voice, so I'm going to open up to some questions from the audience now. I'll take 2 questions in each round. If you could stand up, there are microphones coming around. Say your name, your affiliation, and then ask a concise and pithy question, please. Refrain from long statements, if you would. This lady here first, and the gentleman in the check shirt then. They're switching on back there. Try now.
Good afternoon. My name is Rosemary Segero. I'm a president of a company called Segero's International Group. We focus on SMEs and women and young people. I come from Kenya. Mr. Governor, thank you so much for M-Pesa. But we have a problem sending the M-Pesa from here. But we've come up with our own applications for digital money transfer. But when you send through M-Pesa, the money doesn't get there. What is happening? That's what I wanted to ask the secretary, assistant secretary. What is happening on the road? Because the money is not getting there. It's missing on the round or getting lost. What is happening? Thank you.
And let's get the question from the gentleman over there in the check shirt.
Hi, I'm Carlos Stagliano. I work at Overseas Private Investment Corporation, OPIC. I guess my question is, assuming you know what the SMART campaign is, I'm just curious about how much LDC regulations, the regulatory regime, has already acceded to kind of SMART campaign levels without having to have these MFIs become SMART campaign certified. Like, I just wondered about the level of regulation, the cognizance of, the microfinance difficulties.
For those of us who don't know what SMART is, could you just elucidate?
Oh, sure. It's a voluntary certification or, voluntary certification to protect microborrowers mainly in developing countries.
All right. I think the first question from Rosemary and Chuguna was might be a little bit unfair, might be a little bit on the technical side, but where's the money gone, is what she was saying.
Thank you very much. At least this is 1 year since I left the central bank after finishing my 2 terms. But by the time I left, we had Western Union partnering with M-Pesa, so that when you send your money through Western Union, then it finds, it is channeled through M-Pesa into the holder. You don't have to come to Nairobi or wherever in town to look for money from the Western Union counter. And on the other hand, we think that the developments taking place right now, at the frontier level, especially Kenya and Tanzania, and some certain extent Rwanda, we are now getting to the level where the 4th generation of development. We started with payments. M-Pesa was just a payments. We went into virtual savings account. We went into credit supply, where now we've seen that data on credit and transactions, savings transactions, can be used to rate and evaluate customers. That is credit rating. And now the 4th one is cross-border payments and even remittances. There could be something stuck somewhere, because over maybe very many years since we started in 2009, UK and Kenya, we have never had any problems. So essentially, it must be somewhere along the way something that is not working, but it is worth asking what is happening. But this was being channeled through Western Union. Western Union was not a standalone, it was always linked to a bank. So essentially, it's something that we need to find out. But in future, we would like to make sure that we have just a pure system that you don't have to go through a bank. Because Western Union, everybody complained about the cost of transfers, remittances. And it was coming to about 9.5%, because it not only hits you on the amount you're sending, but also the exchange rate that is fixed. So essentially, it's both penalties. So it's something that we may want to find out. But now, I'm out of the system for 1 year, but I would like to find out from Safaricom itself, to find out where did the partnership go. But of course, we perfected the one from the UK. So it's something I can find out.
It's an impressive level of detail you have at your fingertips. Thank you. The second question is about SMART campaign levels, this voluntary certification. Liliana, why don't you take this on?
As you noticed when I made the presentation on the 3 areas that we focus, consumer protection was not one of them, explicitly being said. And the reason, and we underline that throughout the report, is that consumer protection actually is so important that it's a cross-cutting. We keep referring to consumer protection in all the areas. And the recommendations of the SMART campaign are actually, we actually cite the SMART campaign as endorsing and supporting the kind of work that you guys are doing, even though we do not focus on specific recommendations for SMEs, for example. But it is because it's cross-cutting as opposed to being one particular area of study.
Let's get some more questions. Lady over there in the blue, and then gentleman here.
Hello, my name is Sharina Ravanchi. I work at IFC. My question is about, Liliana, you made an excellent presentation about regulation and not entering too quickly to stifle innovation. And there are certainly a large number of actors, particularly from Silicon Valley, entering the fray, beginning to engage in bank-like activities. And I'm curious as to what is the threshold? Where does that, tamp down to prevent any systemic risks? Or because there are certainly large banks, and I know Jamie Dimon recently had a large interview in Bloomberg about the future of banking, and he's pretty bullish on banks as opposed to digital actors taking over the field. So.
And then this gentleman in the gray jacket.
Hi, Steve Cashin from Pan African Capital. First of all, thank you to CGD, to you, for this event and for the report. It's extremely important. The fact that you've integrated both financial inclusion as well as the regulatory environment is a landmark for those of us who have been investors in emerging markets for a long time. And I think opening up this conversation has been something that we as investors have tried to do for a long time.
I did say no statements, but I think I'll allow that one.
Yeah.
Carry on, sir.
Let me come at it from the other angle. I think the efforts that you're making in terms of inclusion into the financial systems, into the regulatory environment for all financial services are terrific. And I think it's extremely important to integrate products into traditional financial services for them to be able to sustain. My question is, how do we balance really the US regulators' efforts on impact on money centers center banks to de-risk and to cut off the correspondent relationships across many countries in Africa, many banks in Africa, and balance the two to make sense of what you're doing on one side versus the other?
Okay. Let's take that second question first, actually. Alan?
Okay.
Liliana,
Hi, Steve.
Liliana just voluntold you.
I will tell me, yeah.
Because he's the right person to answer that question.
Yeah.
Right?
Okay. Look, Steve. I mean, the sort of the principles set out in the report are that if you're going to have a risk-based approach, you have to first of all be symmetric. You have to include risks of exclusion and you have to include risks of inclusion, right? Then you should be thinking about requiring different levels of due diligence, and then you ought to think about graduating penalties. To give you an example of the last one, and that was quite a contentious issue about how precisely you could do that, but it is done in many areas of law. If you look at the penalties, for example, for theft in Maryland, just to take a random case, there's a very clear graduation of what maximum penalties look like depending on the seriousness of the offense. If you're talking about knowing your customer, it's very different if you let an unauthorized person get into a nuclear facility, which would, I guess, be the equivalent of a major bank breaking sanctions in a big way, versus an unauthorized person participating in a subsidized health insurance program, right? So if you apply those principles, what I think you'd want to do is to clarify a little bit more about what is required, but then also try and graduate sanctions so that if there is some, people can't control all the way down the line what is happening, that is accepted. Because the other alternative is that money goes through non-transparent channels, which is also not helpful. So I think the only way I can see it is to really apply the principles of a risk-based approach in terms of graduated incentives in the process. And I think if that's done with a bit more clarity, it would be helpful. We also do discuss one other thing, by the way, in the report, which is what do you do in really extreme cases? What happens if you have a country with a serious risk and where, for example, there is no ID system and you have no idea really of who you're sending money to? There are a couple of very hard cases, right? And logically, then the only way to do it is to turn it completely around and find some way of dealing with on a positive rather than a negative list basis. That would be very unfortunate. It would be very restrictive, but that would be your only alternative.
Stein, Liliana, want to come in on this?
Yeah. Right, let me start and then Stein could. Your question goes to the core of the report, because the truth of the matter is that you have many players and the combination of players are very different in different countries. You have places where banks are the ones that actually are the best positioned to offer the services. You know, it is very important to underline that we are, and we kept repeating this so many times, we're very agnostic in the report about who should be, what is the right combination of players. Should it be telecom, should it be banks? No, we don't take a position on that. Okay, in some countries, I mean, take India, for example, right? They right now have a new model with the payments bank, and they are positioning themselves to following actually a number of the recommendations that we have here. They came first, not they didn't follow exact recommendations, but they are so consistent with our recommendations in the sense that they are providing very simple accounts, while at the same time taking all the care that should be given for the mandates of stability. But in other countries, like a number of African countries, it's the telecoms that are taking the lead, and they are partnering with banks, and so that is another model. I come from Latin America, a completely different situation, where the banks are, in most of the world, actually, with the exception of Africa, banks are the ones who are actually being taking the leader. One has to recognize that. But the truth is that any model can work. I mean, there are so many. And actually, in the report, we have a box, and the box talks about different cooperative models that could emerge. And the range is very, very large. And I think that Stein can complement it.
Yeah, so I think on regulation, like we said, give a little bit more credence to kind of an ex-ante light approach. Don't over-regulate. Don't really think that you can do it. At the same time, keep the option open. And the interoperability is a very good example. I mean, we wouldn't be able to make telephone calls if we didn't have interoperability between Verizon and AT&T, right? So at some point, you need to see where the market comes together on that issue. And that's one example, but there are many other examples in which there's a role of a government to coalesce the market around a certain standard, around a certain paradigm, and then give a push to that. So I think that's a pro-market philosophy. Now, what this does require quite a bit, of course, is that the regulator and the regulatory agencies have capacity to look from time to time at risk in terms of monopoly and competition that may be creating bad outcomes. We wouldn't want one telecom regulator. We had one in the United States, was AT&T, that was broken up for a good reason, because we realized that having separate AT&Ts was actually going to give us competition. Now, of course, later on the market came back together. We were happy with it because there's enough other providers, etc. So we have to think of that, but that means that the regulator in the various countries have to have some capacity, and it goes back to some issues that were discussed before. We need to give probably more tools, more resources to these regulators to be able to assess those issues.
Okay. Do you have any comments to make?
The only point I was trying to perhaps even build on that is that perhaps we may look at the regulator himself as looking for also coming up with the regulatory technology because of the changes that are taking place. And that becomes very, very critical, because you have to cope with the market demands. And that's why when you say, for example, everybody wherever I go, they always tell me that we don't want a telecom-based mobile banking, a telecom-based kind of digital financial system. Would like to have a bank-led model. And my argument is that M-Pesa is a bank product. It's only that it has peculiar characteristics, that it has been developed jointly with a telecom. And it's the telecom that transmits the process. But because essentially the central bank had no business going to deal with it if it was not a bank product. But it is because of where it, how it has originated, but also what is the face of M-Pesa out there is a telecom company. But if you look at it more critically and how the regulations from the central bank came in and how the uptick was taken up is because of the faith of the regulator. And that's why it's a bank product. But now, that's a good starting point if you are looking for financial inclusion. And that's, for me, that is where you're looking for financial inclusion, you're improving the financial, the payment system. That's how, obviously, it becomes now, in the end, you don't even understand, was it a bank-led model or a telco-led model? So it doesn't make a difference when financial inclusion it was the goal.
Yeah. Okay. Liliana Rojas Suarez, Stein Claessens are the co-chairs of the high-level task force that produced this report. Njuguna Ndungu and Gelb are two of the eminent members of the task force. The report is on our website, cgdev.org. There's also a shorter policy brief with all the recommendations, which is also on our website, and there'll be a podcast with Liliana hosted next week. So check that out once you listen to the one with Njuguna as well. So I'm going to ask you now, please, to join me as we thank our panelists for this afternoon's event. Thank you. And please remember to join us for some refreshments out back over there. Thanks very much.